Hey guys, welcome back. We are back with the 2022 ETF Overview series. Today we are looking at DVY. That's an iShares Select Dividend ETF. It follows the index, the Dow Jones US Select Dividend. And we're going to take a look, do a quick overview of it, look at its expense ratio, portfolio holdings, sector allocation. We're going to look at dividend growth and performance over the past 10 years or so. So buckle in. If you missed any of the other ones, there's a playlist down below that I started last week, and it includes the last four that we've done, last 4 or 5, and I'm starting with the most assets under management and going down the list. So here we are, we're going to start. So DVY, that's the Dow Jones US Select Dividend Index. Now, what is the index? Okay, the index is defined as all dividend-paying companies in the Dow Jones US Index, excluding REITs. Now, to be included in the index, they need to have a dividend per share greater than or equal to the 5-year average dividend per share. They need to have a 5-year average dividend coverage ratio greater than or equal to 167%. They need to have paid dividends in each of the previous 5 years. A non-negative trailing 12-month earnings per share. Why they say non-negative? Why didn't they just say a positive trailing 12-month earnings per share? I don't know. Float adjusted market cap of at least $3 billion, $2 billion for current ones that are in the index. So they can actually fall down in market cap as long as they're in the index. And then a 3-month average daily volume of 200,000 shares, 100,000 shares for current constituents. Now, one thing that's interesting to me is the current index constituents are included in the universe regardless of their dividend growth rate, coverage ratio, and current year earnings per share. So once they qualify, they're in, and it takes a while for them to actually be excluded from the index when they rebalance. In other words, if they fall out of compliance, they won't be looked at again until rebalancing. Now, their weighting method, real quick, is yield driven. So basically, the highest yields are going to get the highest allocation. And they rebalance annually in March. So we're going to go over here to the iShares website and go over the overview here. Ticker symbol is DVY iShares Select Dividend ETF. Currently, as of this recording, at 126.65 expense ratio, 0.38, a little on the high side. So why DVY? Exposure to broad cap U.S. companies with a consistent history of dividend, access 100 stocks with 5-year records of paying dividend, and used to seek income. So we're going to look here at the fun facts real quick. Does pay quarterly. Has $20 billion in assets under management. PE ratio as of January 6, 2022, 19.34. So somewhat of a value fund if you consider the SPY having a PE ratio of 24 currently. 30-day yield right now, 3.57%. Not too shabby. And then let's go ahead and take a look at its holdings real quick. Look at the top 10 holdings as of January 7th. OKE, which is energy. Altria Group is a sin stock, essentially. Pfizer is healthcare. ExxonMobil's energy. People Corporation is a utility. Prudential Financial is financials. AT&T Communications. Philip Morris is consumer staples. Chevron Corp is energy. And IBM is technology. Let's take a look and see if they have the exposure breakdowns. Here they are. As of January 26, 26% of the fund is in utilities. So this should give you possibly a defensive position having this ETF. Although utilities are somewhat negatively affected by rising rates, so we'll see how that works out. Financials 23.5, energy at 9%, consumer staples at 8.3, communications 6.7, materials at 6.6, information technology only at 6, consumer discretionary 4.8, healthcare at 4.4, industrials at 3.8, and a small bit of cash. So they're missing here is, like we said, real estate. So if real estate is something that you desire, you would need to look at something like a VNQ on the ETF, or invest in an individual REIT yourself. So let's take a look. We're going to use Seeking Alpha here for the dividend growth and examine the dividend history. So we'll look here, look at the dividend. They have the current trailing 12-month dividend yield of 3%. Dividend growth rate trailing 12-month 8.56. Dividend growth rate over 3 years 6%. 5 years 7.25, and 10 years 7.5%. 7.54%. Now that is respectable, because typically when you're investing in the higher yielding companies, you don't get a large amount of dividend growth. You'll get some, but they'll be a lot smaller. For instance, AT&T, right? They've only increased their dividend for, like 2% every year. So you're not going to get a major component of dividend growth in a fund that has a higher yield like this. But 7.5% overall, considering the way they weight this with the yield companies taking the highest amount of portfolio assets, 7.5% over 10 years is really not bad. Now, finally, we'll take a look at performance. We're going to use etfchannel.com for this. DVY, we're going to compare this to SCHD, who has been the probably the best performing dividend ETF, especially within the last year or so. And we're going to see how it's done over the past 10 years. We'll go back to 2012. We'll let this populate real quick, and we'll see DVY since 2012 has given you a respectable average annual total return of 12.71%, whereas SCHD 15.32%. And you can see what's interesting to me is that a lot of ETFs have tracked with SCHD for many years until March 2020, and then something in SCHD, maybe it's the screening, really helped it outperform from March 2020 on, and you can see that with the blue line blip up there. So SCHD has been the big winner so far, but DVY, a decent portfolio, probably somewhat defensive with being utilities and financials. Don't know how that's going to work out with rising rates. We'll have to keep an eye on that. But anyway, that concludes the overview of DVY. If you enjoyed, leave me a comment down below. Like, share, subscribe, do all that good stuff. We'll talk to you later. Thanks. Bye-bye. I am not a financial advisor. The information contained in this video is for entertainment and informational purposes only. It is not intended to be investment advice. Please seek a licensed professional for any investment, tax, or legal advice. Thank you.